So I just want to say it's really an honor for me to be. I'm Eric Toder. I'm co-director of the Tax Policy Center. It's really an honor of me for me to be here in this event, honoring Don Lubick, who was one of my mentors and one of my heroes, and I'm really a mentor and an ideal to all of us on the panel and many of us in the audience. We have a great panel here. I will. You have their full bios. I will introduce them very briefly. Manal Corwin is the National Service Line Leader for International Tax at KPMG. She was previously a Deputy Assistant Secretary for International Tax at the U.S. Treasury Department and during the Obama administration, and has done many other things before then. I won't go through them all. David Rosenblum is a visiting professor of taxation and director of the International Tax Program at New York University School of Law. He's also been a member of the Kaplan Drysdale law firm, and David has many other accomplishments, but the one I'll mention is he also was the top international tax official at the Treasury Department. That was back in the Carter administration. John Samuels is now the chairman of Global Tax at Blackstone. Many of us remember him for years as the vice president and senior counsel for tax planning at General Electric. And I also remember John from his service in the Treasury Department during the Carter years, where he was a tax legislative counsel. And finally, we have Barbara Angus, who is the one member of this panel who is now in government. She's Chief Tax Counsel for the Committee of Ways and Means. She has been a senior partner, a principal with Ernst & Young before then, and before then she also was the top international tax person at the Treasury Department during the first term of President Bush, the second President Bush. So I will just turn this over to Manal. Great. And everyone, I think I'm going to try to hold you to 8 minutes each if you could. We're a little behind time.
Faster, but I will take a moment to say I'm privileged to be here, Don, in your honor, and to have served under your leadership at Treasury. And I think moments like that, the moment we experienced earlier and looking around the room, I've had the privilege to work with many of you, and we're reminded of what is important, and I just want to take a moment to say that we have wonderful colleagues, and we wish Bobby the best. So I'm tasked with starting off just to kind of set the stage level set around the BEPS initiative and how it started. I think understanding the origin of the anti-BEPS movement, if you will, which I distinguish from the BEPS initiative itself, is really critical to understanding the current impact on multinationals, but also the relevant impacts on U.S. tax reform. Since the OECD launched its initiative to address base erosion and profit shifting and then coined the acronym BEPS, many have pointed a finger at the OECD or the organization for having opened a Pandora's box that has unraveled longstanding international tax rules and upset what was perceived stability ahead of their involvement. I think a closer look both at the historical record of the OECD in being able to affect significant policy shifts at anywhere near a breakneck speed, as well as its limited ability to keep the BEPS initiative in check more recently, in check relative to its original policy objectives, suggests that the origins and reasons for the BEPS movement goes much deeper than the OECD initiative itself. BEPS is not the OECD's first rodeo in terms of addressing base erosion, profit shifting concerns more broadly. Some relevant examples include, as far back as 1998, which is not that far back, but still far back, the report on harmful tax competition. In 2004, we saw the establishment at the OECD of the Aggressive Tax Planning Steering Group, which was established to identify and share concerns about aggressive tax planning techniques. It started out with the participation of 7 countries, and according to the OECD website, is now 46 countries strong, with an inventory of over 400 aggressive tax planning techniques. There was also the work begun in 2005 on business restructuring to evaluate implications of global restructuring and the incentives to minimize taxation. In 2010 and 11, we saw reports on the tax risks involving bank losses, as well as corporate loss utilization through tax planning. And then we saw reports in 2011 about the need for transparency and disclosure in the case of aggressive tax planning, and a 2012 report on hybrid mismatches before Action 2 was dubbed Action 2. All of these initiatives and reports, while echoing the same themes that we saw weaved throughout the 15 BEPS action items, never resulted in the political call to action that we're seeing now being played out in a number of jurisdictions. Nor did these prior initiatives receive even a fraction of the attention that has been the hallmark of the BEPS initiative since its inception. Indeed, I'd say most tax professionals, except for the people maybe in this room, who might be able to now recite letter and verse of the action plan, the 15-item action plan, never noticed or even worried about those prior reports or initiatives and thought that they were of immediate concern. So if it's not, why now? What's new? And if it's not the OECD's power and influence that's at play here, what is the driver behind the BEPS movement? I think, Bob, you covered a lot of the issues driving it, but it was very much the political environment and the public and political environment, largely outside the United States, that was really launched the OECD initiative into what it is today. We know the numbers of factors that have contributed to that environment. It was the financial crisis. It was the political pressure that politicians were under relative to their handling of that crisis, and the resorting to austerity measures, and just an increased public focus on whether or not multinationals were paying their fair share. So that is really what spurred politicians into action. The original goal then of the BEPS initiative at the OECD was to temper that rhetoric, in fact, and mitigate the risk of what was viewed as politically driven unilateral action. And there was a fair amount of concern that that action would in fact undermine existing international standards and consensus. To that end, in February of 2013, the OECD announced that it's going to take this initiative over in an attempt to evaluate and maybe change the rhetoric. When that initial announcement was made, there was a point of focus that was not on the behaviors of companies, the compliance habits of companies, but rather on what are the limitations of current rules in a modern world. And that first report was full of statements around what we're really looking at is to evaluate whether current rules are fit for purpose. The other thing that report emphasized was that unilateral action would be disastrous for both business and for governments. And the initial reports promised that they were not going to relitigate the issue of source versus residence country taxation. What happened since, I think, is telling as to how much of this was an OECD-driven initiative versus really driven by forces outside the OECD. Initially, obviously, politicians welcomed the report. It was endorsed by the G20 repeatedly, and the G20 has increasingly become involved in ways that we would have never imagined back in the Lubeck era, for example, at Treasury, the number of G20 reports that include tax. Those political forces, though, not surprisingly, the political forces that led to BEPS and had the OECD sort of attempting to mitigate the direction it was going, are also not surprisingly, leading to some of the outcomes that we're seeing from the project, and have made it very difficult for the OECD to maintain control of where it's going. The increasing rhetoric, we've seen that the increasing rhetoric has continued in terms of looking to what multinationals are doing. We've also seen that ultimately the source versus residence country taxation has been reopened, and unilateral action has not been stopped. So I'll just conclude by saying the relevance of that observation and the impact on reform is understanding, as we look through to what extent we ought to consider the BEPS initiative in pursuing U.S. tax reform. It's important to understand that it isn't just about the OECD, and we shouldn't have to worry about the OECD as we think about reform, but it's broader than that. And to the extent that the goal of U.S. tax reform is to preserve the interests of both the U.S. government and U.S. Companies and residents or U.S. interests, those interests are clearly impacted by the behavior of other countries. And the U.S. tax base can be eroded not only by the behaviors of multinationals, but by the behavior of other governments.
Thank you. David?
Well, thank you, and thank you for the opportunity. Good to be here, Don. Thank you very much for this opportunity to speak about policy and reform. It seems to me I've seen this movie before, however. We all love to sit around and talk about policy, and I will get to policy in a second. Let me just say that while we talk about policy, our tax system is being slowly eroded in the level of administration. It doesn't matter what the rules are if you don't have people to enforce them. And if you just take even a wink, even a quick look at what's happening to the Internal Revenue Service in the last few years, you would realize one of the reasons why it almost doesn't matter what the rules are. We've lost so many people in the Revenue Service that the enforcement capability is diminished dramatically. And unless that gets rectified, frankly, who cares about tax reform if we don't have a tax system? Saying all that, I'll now turn to tax policy. I see BEPS as the sort of the revenge of the source basis approach to tax. And part of it, I think, is true. I get this a little bit from what Bob Stack said, because the deal, as I understood it coming out of World War II, was that in the eternal war of residence and source, the source countries would limit their take of tax, and the residence countries would undertake to avoid double taxation. And that's been certainly the U.S. view of the world. It's particularly and dramatically reflected in our treaty policy, where we are way beyond the OECD in favoring the country of residence. What's happened, I think, is that that the residence countries, and we were, and still are, presumably, the premier residence country, failed to do their part of the deal. They failed to impose tax on their own taxpayers. I think you could draw a direct line, not even a dotted line, between check the box and BEPS. I think BEPS is a direct reaction to the check the box rules. And they were used aggressively by U.S. taxpayers in ways that got under the skin of a lot of countries. I think it was probably a foreseeable thing that would happen. You had to take, I think the problem, I'm unlike John, I've never been inside a corporation, but I think the problem inside a corporation is the war between the long view and the short view. I mean, it does seem to me that taking the short view in terms of tax planning has resulted in a lot of pretty aggressive things, which have led ineluctably to the BEPS, what we see in BEPS. Saying that, the question for me has been, how should the United States react to that? We've been the premier country going around the world telling other countries, be reasonable. If you want our investment, limit your tax at source. And frankly, the Indians, the Chinese, the Brazilians, a lot of other countries, they're just not buying it anymore. I mean, they basically are answering us, look, we'll set our own tax policy, thank you very much. And by the way, you guys in the United States aren't doing such a great job either. And frankly, that's where we are. I think we have to come to terms with that. There's only a couple of things I think we can do. So far, my perception, some will say this is unfair, is that our policy has essentially been to do nothing. You know, pretend that BEPS doesn't exist. Unfortunately, it does exist, and it's going to be, I think the upshot from BEPS is going to be quite dramatic for a lot of companies. I don't think we can do a heck of a lot about it, although I do hold hope that we can improve dispute resolution mechanisms. I think that's the one aspect of BEPS, and the efforts of Bob and others to advance ways of getting disputes resolved, because I see a lot of disputes on the horizon. So one thing we could do is do nothing. Another thing we could do is double down on our basic policy of saying residence country rules. We go around to Brazil, India, and we try to convince them to be reasonable in their treatment of our companies. I've had a fair amount of experience recently, particularly in India, and I tell you, it doesn't work very well. I don't see that that's going to be fruitful. The third thing that we could do, and I think it really is something that is long overdue, is that we could rethink the balance between our own source basis taxation as opposed to residence basis taxation. I think if you wanted to put your finger on at least one of the major problems with tax policy, international, cross-border tax policy in the United States, it's that everybody seems to think almost exclusively about the outbound rules. I've seen entire books written in this town called International Taxation where there wasn't a word about inbound. But guess what? The inbound investment in the United States on a year-by-year basis is just staggering. I saw that the statistics this morning. It ain't 1946 anymore, guys. And so we really ought to revisit rules that have been in place for over 50 years. We haven't touched the Foreign Investors Tax Act from 1966 except at the margins, and it's time to rethink that. And it's time to rethink our treaty policy as well, in my view. I think that if you wanted to address inversions, lowering the corporate rate as a means of addressing inversions is, in my view, mindless. You can't get the rate even close to being low enough to remove the incentive. But what you can do is you can pay more attention to the inbound investment once people do invert. Because why people invert at the end of the day is it's just better to be foreign in the United States. We treat people better, our rules are more generous, the IRS audits of the inbound investors are much lighter and in many cases non-existent. All of that needs more attention. It isn't going to be cured by just a little bit of policy around the edges. We really need to rethink where we stand in the world. We don't stand in the same place that we stood in 1962 and 1966. And in my opinion, what is really needed is a thoroughgoing review of our statutory law on inbound investment. Next comes treaties. I think we are way too favorable to the residence countries in treaties. I have said, these are sort of radical thoughts. Nobody pays attention to what I say anyway, but I think we ought to just can the non-discrimination clause from treaties. Why? Because we want to discriminate, and we do discriminate. We just say we're not discriminating. So let's get a little less hypocritical about our rules. Let's rethink the way. I was disappointed to some extent in the new model treaty, which doesn't go far enough, in my opinion, for a complete rethink. You can't really do it, though. You can't start with the treaty. You have to start with redoing the statute, rethinking the statute. So my third approach, the three approaches that I see to BEPS are do nothing, double down on convincing the rest of the world that it really is right that the residence country, the source country should reduce tax and the residence country will undertake to avoid double taxation, or maybe take a few leaves from the book of Brazil, India, and China, who say, look, we've got a market, and we're going to impose tax on the entry into our market. We have a market too in the United States, and I don't think you can plan around that market. That market isn't going anywhere. And so it seems to me that that's what I would see as coming out of the BEPS material. Thank you.
So first, let me say how delighted I am to be here and to thank Don, because without Don, I wouldn't be here. I was a lawyer laboring in a Wall Street law firm, and Don called the senior partner in the firm and said, do you have anybody who's foolish enough to come to Washington and work twice as hard for half the money? And the partner said, yep, I've got just the guy, and it changed my life. It's without Don, I wouldn't be here, and I thank you. So I rarely find myself in agreement with David, but I certainly do, and I'll get to that in a minute. I really think we need to focus a lot more on our source-based taxation, although, as Alan Auerbach said, we don't know what residence is anymore, and we don't know what source is anymore. So what we really need to focus on maybe is destination, which is what David's talking about, I think. To frame international tax reform, I always like to start outside the tax world. What is it we're trying to accomplish? And I think the answer is maybe to raise revenue, but probably not in this area, but to increase the standard of living, increase investments, jobs, competitiveness of U.S. firms, but only to the extent that it's a vehicle to increase the U.S. standard of living. So how do taxes come into play in this world? Well, how should we change our tax system to do that? I actually think looking at what other countries are doing is a good place to start. I don't find race to the bottom very helpful. It's a label, and maybe it's a race to the top, because what they're looking to do is attract investment, and they're using their tax systems to do that. And I have only two reasons I can think of as to why we wouldn't look at what other countries are doing. One of them is maybe we think we're smarter than the rest of the world. Well, you know, and for a long time we did. It's pogo. You know, we met the enemy, and he is us. Well, that's no other country in the world could put it together a group of people like in this room, and maybe that's a blessing, maybe it's a problem. But we're not smarter than the rest of the world. Or then maybe we're different than the rest of the world. Well, maybe we were once, when we had the big, large U.S. market to ourselves and didn't have much foreign competition. U.S. firms didn't have to compete abroad. 1960, no longer. Today, as a result of technology, trade, low-cost transportation, the U.S. is a small, open economy. Larry Summers and Jim Hines did a great paper making that point. So we ought to behave like one. We aren't different than the rest of the world anymore. So what is the rest of the world doing? They're lowering their corporate rates. They're adopting territorial systems. And let me be very clear, they're adopting territorial systems without minimum taxes. And by what I mean by that is current home country tax on active business income. If it's passive interest income, maybe that's one thing. But active business income, nobody is doing it. And it's a very bad idea. In my view, it's a hybrid system. It's what we have today. It's too broad. It will hurt the competitiveness of U.S. firms. It's too narrow. It will not stop base erosion. We have a 15% minimum tax. We have a headline rate in the U.S. of 35. Intangibles will still go to take advantage, arbitrage that 10 or 15-point difference. And it won't raise any money. Foreign governments will raise their rates to soak up the minimum tax, and U.S. multinationals will stop planning to reduce their rate to below 15%. It's just a bad idea. And no other country has one. All right, so if we're going to reduce our rates and adopt a territorial system, how do we pay for it? Rate reduction. I'd start with base broadening on things that can't move. I'd rely on the Ramsey rule. I would slow depreciation on things like utilities and railroads and pipelines and telecommunication and cable, leasehold improvements, things that have to be here and can't move and aren't in the traded sector. This is what the UK did. It's what we do with real estate. It's kind of, as I said, the Ramsey rule. I'd capitalize a lot of things. Repairs, advertising. I understand that's a timing item and pushes the revenue loss outside the 10-year window, but we're going to be using dynamic scoring, whether you like it or not. We're going to be using dynamic scoring, and dynamic scoring shows a lot of growth outside the window. The UK did a study and showed that 60% of the revenue lost from their rate reduction would be made up by economic growth in the long run. I'd adopt thin cap rules like the rest of the world. And then if I needed more money, I'd shift the burden of capital to individuals, either through integration, dividend, with a dividend deduction or credit system, higher taxes on dividends or capital gains, accrual taxation, as Eric has recommended, or even a PFIC regime like Harry and Roseanne have recommended. Individuals are less mobile. How to pay for territorial? Well, first, on a static basis, territorial doesn't cost very much. Harry and Roseanne did an analysis that in 2006, if you exempted dividends, exempted all dividends paid by foreign firms, you'd raise $1 billion. So on a static basis, we're collecting no revenue. Having said that, the Joint Committee has estimated that moving to a territorial system would cost, at a 25% rate, $220 billion, or at a 35%, maybe 300 to 400 billion. And I think there are two pieces to that revenue loss. One is incremental income shifting from a territorial system, and two is the Joint Committee is anticipating that dividends will come back in the 10-year window that won't be sheltered by credits. I don't know why they're assuming that. They haven't in the last 20 years, and I don't think they will in the next 10. But having said that, that's the headline number. So I would address, instead of using a blunt tool like the minimum tax, I would address base erosion. And believe me, I think it's a problem. I think it's a big problem. I don't think it's a bigger problem under territorial than it is today. I think today it's a heads I win, tails I lose. I shift anyway. I can always bring it back. I think it's a huge problem. I try to identify where the problem is. So where is the problem? You go to your CFO and you say, I'd like to move something offshore. Well, when do you move something offshore? For tax reasons. When the tax savings are greater than the non-tax costs of moving. When is that? You've got to have big tax savings that you can count on. When do you have big tax savings you can count on? When you have high margins for the foreseeable future. When do you have those in a competitive market? Only when you have protected intellectual property. That's the only time you can have high margins over a long period of time. So that's the plus side of moving. What are the costs? The costs of moving, if you have your products can be put into a FedEx envelope and shipped or sent over the internet, very low cost. Think high tech, think pharma, think intangibles is where I think the issue is. Today, and it's very easy to move patents to Ireland. But the problem is the way our tax system works today, if you move patents to Ireland, you have to also move your manufacturing outside the United States. So I can explain that later. I have a couple of minutes left. That's a big problem. We have no high-tech manufacturing in the U.S. anymore. And I think my thesis is the IP is outside the U.S., and because they can't manufacture in the U.S. because the royalties paid would be Subpart F income, or if they had a contract manufacturing arrangement, there'd be a permanent establishment here. We're hollowing out our base. So I would address this outbound base erosion with very tough transfer pricing rules that would be formulaic. I'd outlaw cost sharing. I'd outlaw contract research. I would put I'd use something called the realistic alternatives test, and I'd limit the return in a cash box to the weighted average cost of capital of the parent. Pfizer doesn't go out to finance its next drug to go to a venture capitalist. I'd also provide a patent box, but it would be a low rate, but the R&D would have to be done in the U.S. The R&D would have to be scaled here, meaning you'd have to manufacture here, and I'd only apply it to very high margin stuff, the guys who move. And then I'm out of time, I'm in my negative territory. I would think about a DP, to what David said, I'd think about a DPT, a diverted profits tax for the United States. What we have left is our large U.S. market. The India and China, and now the UK has set the path for it. I think it's a lot of sense for us to explore that. I'm out of time, and otherwise I'd tell you why I think it makes sense and how we could do it, treaty, and deal with our treaties.
Barbara?
Committee and also and sometimes we were on the opposite collegial way and made clear that in his view we were both working to the same objective, a better tax system. So it's a privilege to be here today, Don, at the first Donald Lubig Symposium. I thought the question that was posed to this panel was a really important one. And I think it also has a really simple answer. Foreign tax changes do have a dramatic effect on U.S. businesses, and they further reinforce the need for fundamental tax reform in the U.S. So that's my simple answer. I'll elaborate for a few minutes on that. Over the last decade, countries around the world have been reducing their corporate tax rates. The UK just announced a further reduction to 17%. That's less than half of the U.S. rate. In the same time period, countries around the world have been replacing their worldwide tax systems with territorial approaches for taxing the global businesses that are headquartered in those countries. The Fortune 500 used to be dominated by U.S. headquartered companies, but those spots are increasingly being taken by foreign headquartered companies. These developments all matter. The U.S. tax system must be modernized to reflect the modern world. More recently, the focus on BEPS has led to an anti-corporate sentiment around the world, largely focused on household name companies, largely focused on household name American companies. And rather than seeing coordinated change in international tax policy that I think the OECD was seeking to deliver, what we're seeing are countries using BEPS as an excuse to justify what are often blatant revenue grabs. There are many examples of unilateral action being taken in the name of BEPS that are at odds with the BEPS recommendations. The UK diverted profits tax is one example, a response to concern about the permanent establishment rules, but a very different response than the response agreed to and negotiated in the OECD that involved amendments to the permanent establishment definition in the treaty. The one could say that the US 385 regulations, which are controversial for many reasons, are a very different response to concerns about interest deductibility than the BEPS Action 4 and the agreed recommendation with respect to limiting interest deductibility. The recent EU efforts toward requiring public release of country-by-country reporting information is in sharp contrast with BEPS Action 13's mandate for reporting of this information to tax authorities only. It seems likely that this is just the beginning of a long line of unilateral actions justified by BEPS, but not in line with the agreed BEPS recommendations. The EU state aid cases are another example of law being applied beyond its original intent to target corporations, and again, almost exclusively American corporations. And in the US, we're seeing increasingly American companies forced to consider a foreign acquisition or to succumb to a foreign takeover as the only way to remain competitive in the global marketplace. These transactions are labeled inversions, but we should recognize them for what they are, a means for survival. The Ways and Means Committee held a hearing earlier this year on the global tax environment in 2016 and what that means for tax reform. And the clear conclusion was that we need fundamental tax reform that includes a modernization of the U.S. international tax rules. I think an important point that was driven home at that hearing was that international tax reform is not just an issue for global American businesses. It's an issue for all American businesses. If a global American company is forced to move its headquarters to a foreign country through an acquisition or takeover, that often means that over time, key decisions that used to be made in the U.S. will be made overseas instead. That's something that will be felt throughout the company's supply chain, including the local businesses that provided goods and services to the American company. It also will be felt in the local community, where the company provided support to the symphony, to the museum, to the local sports teams. I think in looking at this issue, building a wall is not the answer. Tax reform is the answer. The Ways and Means Committee has been charged with leading the effort to produce a blueprint for comprehensive tax reform that will lay out the House Republican vision for a 21st century tax system. That will be released this summer so that the committee is ready to lead the effort to enact tax reform in 2017. International tax reform, of course, is an integral part, an integral element of comprehensive tax reform, as it involves particularly complex issues that include the meshing of U.S. tax rules with the rapidly changing rules of our trading partners. We've seen that the crafting of new international tax rules benefits from consultation and input. We need more input. We need to spend more time looking at what is happening in other countries. And by that, I don't mean that we should follow the lead of other countries. The international tax rules that other countries choose to put in place may well not be at all appropriate for the U.S. and the U.S. economy, but it's very important that we understand them because of the impact they have on U.S. companies investing in those countries and the impact that those rules have on foreign companies that seek to invest in the U.S. So we need to understand what's happening in the rest of the world. As we look to international tax reform, we'll continue this consultation and input process this year so that we're ready with the right international tax reform package as soon as it can be enacted into law. So returning to the question that was put to the panel, foreign tax changes are significant. They do affect U.S. businesses, and they ratchet up the need for U.S. tax reform.
Okay. Does anyone have any responses to anything that was said?
I agree with David Rosenblum that we should be looking very carefully at more, I don't know whether you want to think about it as a destination-based income tax on sales into the U.S. or exploiting the U.S. market, or anti-base erosion. But I think all of our focus on base erosion has been on outbound base erosion. Not to say that's not a problem, and it should be dealt with. And if we do that, other countries are likely to retaliate, and that will solve the nowhere income problem. Countries acting in their own self-interest.
So just picking up on that, I think one of the things that I'm struck by is, to the extent the concern and the impacts of what's happening right now is you have a lot of unilateral action and not coordinated tax policies looking to tax source. It is a relitigation of source and residence, but without the coming to the table to have the conversation and strike the deal the way the original deal was struck between residence and source. Is it really clear that if every country just does its own thing, figures out how to get more source country taxation with respect to its inbounds, makes an adjustment, maybe it's territorial, that we will solve the problem being faced by companies now in terms of the clash of these tax rules? So just take a hypothetical. If the U.S. were to move to a territorial system, so the U.S. company operating outside the U.S. doesn't have to worry about double taxation vis-a-vis the U.S., the approach to source country taxation right now doesn't necessarily mean that it's not going to worry about double taxation with respect to multiple jurisdictions claiming the tax with respect to the same revenue. So don't we need to do something more than simply think about domestic reform, and is there still room to have coordinated action in the international space?
We may need to do something more, but I think it's critically important that we do something domestically. All of the change that's happening around the world has disproportionate impact on U.S. companies because of the ways in which our international tax rules are completely different than those of the rest of the world. And if we move our system, our international system, more in line with the rest of the world, if we move more to a territorial system, eliminate the lockout effect and what that does in terms of the buildup of foreign earnings, I think that puts us in a better position to have the larger discussion. But right now, an action that's taken by another country has a different effect on the U.S. than it does on that country's other trading partners.
But I don't disagree with a territorial system under certain conditions, but it seems to me that again, that BEPS is not, or the world is not simply going to territorial, it's going to an increased emphasis on taxing the domestic marketplace. And unfortunately, Manal, I think the debate is gone. I think it's too late to try to persuade people that we ought to all get together and get serious about residence taxation.
Or source, even a coordinated source approach.
Well, I'm not sure you can I like Bob's statement, but I thought it was, and he has to be this. He gets paid to do this. It was idealistic in terms of what I've been at the table with some of these countries, and I mean, there's only so much persuading you can do. I think we have to act in our own national interest. It's just that we haven't had a coherent discussion about what our national interest is. Our national interest can't be confined to just always reducing the tax on outbound investment. That can't be the end. First of all, we can't pay for that, and secondly, we ought to be paying attention. These other countries are not completely stupid. They're acting in their own self-interest. They're doing it for a reason, and we have something to learn from them. We're not going to be able to dictate the international tax system. There was a time in our history when we could come pretty close to doing that, but those days are long gone, and BEPS is the proof of it.
So, can I ask a question?
Let me just respond to David.
Okay.
So the world is a big place. It isn't all homogeneous. If you look at the capital exporting countries, Europe, and they all have remarkably similar tax systems. And if you believe in markets, and my friends, the economists, have taught me to do that, it's like they got into a conference room and agreed on how they would tax outbound investment. Not at all territorial, and they've lowered their corporate rates. And they did that because it's in their own self-interest. They want revenue, but they also want investment. They're acting in their self-interest, but they have harmonized. They have actually harmonized on outbound investment. We are an outlier. On what we call the source country, the big rich markets, India started with the Vodafone case. They said, well, we don't care about this permanent establishment stuff. This is all crap. I actually think they're right. It's a construct of wealthy countries who are going to use their markets, and you don't have to pay any tax. China follows. Now the UK is following. So let us join. We have a big market. Bob Stack said the UK is doing two things. They want headquarters. They want to tax source-based income. Great. We should want the same thing. They want their multinationals to thrive outside. They've adopted a territorial system. Great. We can have both. So it is. But David said it. The goal should be national interest. And back in 1962, when the architecture of our basic system was put in place, the goal of every economist, and was Peggy Musgrave from then on, was global welfare, not national welfare. National welfare is a relatively new starter in the international tax policy debate.
It's easy to be a moderator with this panel.
I just one word, which is John just pushed one of the buttons that I had previously pushed, which is.
But you agree.
I think the OECD is the wrong forum for us to be trying to make progress in. First of all, I'm not saying drop out of the OECD, but the OECD has got this urge to democratize and to admit to the table a bunch of countries that don't have many common interests with us.
Rich man's club. It's a rich man's club.
It isn't anymore. And so the lowest common denominator is getting lower and lower. I think what we ought to be doing is forming coalitions of like-minded capital exporting countries to talk about these problems on a one-by-one basis. I think it would be in our own interest to have groups. We do have some of these groups.
David, we have things in common with market companies, with countries as well.
Both.
I mean,
We
we're
have
both,
both.
I think
right?
that's a really important
Yeah.
point.
We
I
have
mean, this
both.
dichotomy between source and residence country, I think is a sort of a false choice for the U.S. when we are both a source and residence country, and we want to continue to be both.
Right, but we've overemphasized residence to the exclusion of source for far too long.
Okay, so as a naive economist, I'm going to ask a question about source. Because when I learned international tax, I learned that there were a form of coordinated system, and the source country got the first bite of tax. Whether there was a residual tax afterwards, countries could decide. So the question then, when you have IP being a main driver of value, where is it appropriate to tax those IP profits? That's something I don't quite understand, and I'd like the panel to help me with. I think John is telling me destination, but I have a funny feeling about that. If you say a company develops IP in the United States and then all their business is exports to other countries, does that mean all the other countries tax it because that's where their sales are? I'm a little, need some help.
Really hard question. You say source, the historic concept is where is the income earned?
Right.
And I'm thinking about source in where is the product consumed. When I think about IP, the only thing that protects it are laws, patent laws. So maybe it should be, if there weren't patent laws in different countries, then in other words, if you invent something in the US, and if somebody in France, we didn't have treaties, somebody in China could copy it and earn it, the rents would disappear very quickly. So it's probably the country whose laws are protecting the rents as to where the IP income is earned, at least in a conceptual sense. But net, I can move my factors of production, I can move my residence, I can move where I do my R&D, not as mobile as people think. The one thing I cannot move is my customer. I cannot move my customer, which is why a VAT or destination-based tax. So that's the only ultimate answer to tax it, I think.
Well, I think what you need is a careful review of that very question, because I'm not convinced that it's an either-or answer. I'm not convinced that there's one answer to that. For example, my instinctive response to your question is, where are the deductions being claimed? That's what a source country would tell you. If you ask them where the income is, they're going to ask, well, are we going to allow the deductions? If they're allowing the deductions, they're going to want at least some of that income, regardless of where the customer is. But I'm not excluding John's analysis.
So, but I think with John's analysis, there's still, I think it begs the question as to what, in terms of where it is consumed, what is the value attributable to that consumption, right? There's going to be components of value, and there's still this question of residual. Is there a residual that goes to the owner or the developer, or is it all somehow transferred and divided up to the consumer? And just to reinforce a point I made earlier, what if one country follows David's approach and looks to where it's developed or protected, and the other is looking to where it's consumed, and don't you have multiple incidents of taxation of the same income?
You do, but I think that's inevitable. The reason for preferring residence taxation to source taxation, if you get away from selfishness in countries, is that the residence country is in a better position to avoid double taxation. And for years, the international taxation was dominated by the concern for double taxation. But there's been a subtle shift. I think we all know it. And the modern concern isn't double taxation. The modern concern is double non-taxation. And so, yes, the shift from residence to source is going to be accompanied by international double taxation. I think it's inevitable when you move to a more source-based world. But I don't think you can stop that. I think we have to come to terms with the reality of what's going on. We're not leading the world. We're following it. And some of this discussion, by the way, puts us in a posture of being a following country, which at least when I entered this business, back when, as my daughter said, when the dinosaurs roamed the earth, it was, we were the leaders. We're not the leaders anymore. I sound like Donald Trump.
Can we be
Sound like Donald
I was
Trump,
going to say, can we be team player? I mean, if we're not leaders, do we pack up our toys and go home, or can we be team players?
I think we ought to learn.
Put in a plug for coming back to the economics answer, that you're supposed to income is earned where the economic value is contributed. And yes, an intangible transaction is really complex, and there's value in various different points. But I guess I still believe in the fundamental transfer pricing concept that you should see what were the contributions to value and where were they made, and the income earned should be divided among that. And so I continue to be grateful for the work that Bob Stack did at the OECD in defending the transfer pricing rules in this area. I think they're really important.
So that leads to a follow-up question. Was that the right choice by the OECD to continue the transfer pricing, or should they have looked at a different paradigm for allocating income?
Well, I've tipped my hand that I think
we know your answer.
I think transfer pricing is the right choice. I recognize that every few years there are calls for a move to formulary apportionment, and I think any formula is by its very nature artificial and arbitrary. So we're having this discussion today about all the disagreements among countries. I can't imagine how countries could agree on a formula, both on the formula to apply, and then more importantly and more fundamentally on the day-to-day implementation of that formula consistently over years, and that's what would be needed. So I come back to transfer pricing, that it's complicated, but it is grounded in an economic truth. Where is the contribution to economic value? And I think that any agreement needs to have an anchor like that.
But Eric, to your question about the transfer pricing between a parent and its wholly owned subsidiary, can that ever be arm's length? And I actually don't think it can. I mean, the Treasury just told us you can't have debt between your almost virtually told us, right, between your parent and your wholly owned subsidiary. This whole notion of transferring risk from the parent to your subsidiary, in the captive insurance area, you don't get away with that. You can't do it. Why we allow this fiction that the subsidiary is a separate taxpayer and it's arm's length, and this is what a venture capitalist would have charged. So I think I'd respect the foreign entity, but I might need some tough guidelines around what arm's length means when I'm dealing with a wholly owned or controlled subsidiary.
Yeah, I think that's right. I think it's a false dichotomy to set formulary against pure arm's length. There's a whole bunch of steps along the way there, including presumptive rules. I mean, again, you know, I was certainly one of the people who thought that the Brazilians were nuts with their system, but I no longer think that. They are slightly nuts, but they're not as nuts as I thought they were. You know, they have basic formulas. They're very rigid in their application of their formulas, which I don't like, and they don't bend in treaty negotiations, which I don't like. But it does seem to me you could go a long way with presumptive rules in transfer pricing, and that's the way the developing world is going. They can't apply a pure transfer price rules like we have in our regulations. By the way, we can't either, which brings me back to tax administration, which is, I think, really the elephant in the room. It doesn't matter what the rules are if you don't have anybody to enforce them. Seriously, and that's where we're headed.
Well, on that note, I think I'll throw this open to the floor. Bill?
So on the question, assuming we'll solve the business tax issues later, on the question of the impact of foreign rules on the U.S. system and U.S. reform, following up on something Bob said, something John said, which is context matters, and let's start with first principles, or let's start outside the tax system, or at least the business tax system. John, at the end of your presentation, you talked about maybe making up revenue on the individual side. And with the debate about wealth inequality that we're hearing now, it's not exactly what we're talking about business tax reform, but when we think about what other countries do on the individual side, or what other countries do on the carbon tax side, or the VAT side, how much of that should we be, I was in Europe recently, and I was shocked to hear that Switzerland has a progressive fine for you get into an auto accident. You pay more the wealthier you are. Of course, wealth taxes you see around the world. A whole bunch of
Hire
other
a chauffeur than a low-paid chauffeur.
Exactly. So what role for all these other changes, in particular on the individual side, with wealth inequality being such an important part of the debate today?
So let me try. First of all, what stunned me a little bit through a lot of this conversation today is we keep talking about corporations like they pay tax. Right. We don't pay tax. We all, I learned that from you guys a long time ago. Not only do we not pay it, if we did pay it, we wouldn't pay it. It's borne by people. I think people, you want to tax what's not mobile. People are not mobile. And well, you can move from New Jersey to Florida, but we don't let you move to Bermuda. We figured that one out. But where the real money is here is, look, the rates, our top rates are getting to be about as high as they can get. And our top rates are as high as the rest of the world's are not any higher. It's where they kick in. The middle class in this country is getting a free ride. The very top rates in foreign countries kick in around, I'm going to pick a number, but $120,000, $150,000. And that's where the money is. If you look at and it isn't really capital gains, although you can tax capital gains. If we raise the rate on capital gains, we've got to tax gains at death. Otherwise, the lock-in would be terrible. Or maybe carry-over basis. Don and Hank had carry-over basis in the law for a while. He had gains at death. All right, so the Lubick tax, gains at death. But the answer is yes, if we can tax what's not mobile and tax. I'm not so convinced taxing consumption. I know you guys all think it's the greatest thing in the world. I'm not so convinced it's so pro-growth. Once I read Alan Auerbach, and is it Kolikoff, is that his name? That all the gains are from the double tax of accumulated wealth, and then once that's gone, not so sure it's any different than any other tax.
But John, the answer is yes to, I mean, Phil, I thought the point you were making is that we tend to compare ourselves with other countries on one spectrum or one aspect of their tax system and not the full spectrum. So even if you go to the individual tax and say, well, as compared to other countries, the middle class in other countries pay higher, income taxes, but they're also getting significant amount of services and other benefits. So if we were to compare the full spectrum of impact, financial impact on individuals in other countries, it's a very
Well, they have a VAT too, but their public sector their government has a much bigger piece of the economy than we do in this country. Now we're catching up.
I don't think we ever really know how the tax system in another country applies in full. Yeah. I mean, we read the statutory rules, we talk to experts, but in the actual application, we tend to impute to the country our own understanding and our own practices. And our own practices, and for that matter, our own culture, is not found in other countries. I just saw, for example, I just read a paper done by, I think it was some economists in Asia, on the effect of Japan moving to territoriality. And this paper came to the conclusion that territoriality in Japan didn't make much of a difference on corporate behavior. Well, that's fine. I mean, it's fine for Japan. But to take that conclusion and apply it outside Japan is crazy. I mean, Japan, I've dealt with Japan enough to know that it's the most tax-compliant country in the world. You can't take a study of Japan and say the conclusions that you've reached, no matter how good they are applicable to us, to our country. It's not true. And
Japan's territorial system looks very different than other territorial, to make them all,
And I think that would be true in every country. I mean, in the UK, I don't know the deals that are made by the tax inspectors in the UK. I would be very suspicious of any comparison of a part of a tax system. I lived through all of that, about how the Japanese were more generous than we on giving the foreign when they had a credit system. Sure, they were more generous, but their credit system only went down one tier. I mean, the companies would pick and choose, taxpayers would pick and choose, cherry pick from other systems and say, let's adopt this, let's adopt that. But I think the overall comparisons are fallacious generally.
I find myself agreeing with David. Just concerned.
Everybody's agreeing with David up here.
But
David's going to change his views.
It's really important that we understand what other countries have chosen to do and why, because as a part of the global economy, all of those choices affect the U.S. But it doesn't mean that any of those choices are right for the U.S. Our choices just need to be informed by what's happening in the rest of the world.
Another question?
Sorry.
Oh, could you identify yourself?
Yeah. Oh, sorry. Seth Green. I wanted to address the point that John made a while back. He was talking about, it's not a race to the bottom, looking at other countries. And I guess the question I would argue that headquarters taxation and the remnants of a residence-based system is really a way of collecting rent from the rest of the world, right? You get your company headquartered in some place, you take advantage of treaties to reduce source-based taxation, and you collect a little sliver, whether it's some small amount of residual residence-based taxation or just the tax on the salaries of the people who moved because you're a headquarters company. And so if you view residence-based taxation and headquarters taxation through that lens, isn't it not true that the U.S. is like every place else because we're bigger and so we can benefit from rent from other places less than they can benefit from renting us?
There were so many double negatives there. I'm not sure.
Sorry about that.
I followed you, but the answer is I don't think this is about headquarters or inversions. I think they're a symptom of the problem. I think the real issue is assets want to be owned in the hands of someone where they produce the highest after-tax rate of return. So if somehow we could just stop all acquisitions of U.S. companies, cross-border mergers, stop them, that wouldn't stop capital from flowing out of this country. It would flow out at the portfolio level. Assuming now our rates were higher and we had a worldwide system, shareholders would sell GE stock and buy Siemens. U.S. companies would sell divisions. Merck sold its consumer products division, Dr. Scholl's foot pads, Coppertone, other things. They put it out for bid. It was a global business. Bayer, a German company, beat Procter & Gamble in the bid because Bayer could bid, and China was the big potential market for this. a buyer could bid and assume it was only the Chinese rate that was going to pay on those Chinese profits. P&G had to bid, assuming it would pay the U.S. rate. So it's assets, it's startups. It's what I call creeping acquisitions, which is the slow loss of market share by U.S. firms. Charlie Kingston, some of you may have known him, was a great New York tax lawyer years ago, said, the biggest mistake we made was when the U.S. had all the capital in the world and all the headquarters in the world, we should have dropped our corporate tax rate to 20%, adopted a territorial system, and not let these other places nibble us to death, slowly attracting investment, real assets, et cetera. And we would have had a higher tax base today, more headquarters, more investment. You really, in a global economy, can't keep mobile capital in a place taxed at a high level when other countries aren't taxing it. Maybe when it was Bermuda or the Bahamas or Barbados, you could, but not when it's the UK, not when it's developed countries. You just can't do it.
I actually agree.
Source meaning where the income is earned. I don't know where it's earned. If I do my R&D, and we do our R&D at GE, we did in 6 different places, and the scientists were talking to each other on the internet. Then the raw materials are sourced one place. Different components are made in different countries. They're shipped to a place, they're assembled. The marketing is somewhere else. You tell me where that income is earned.
You know, John, if you were looking at that question, and instead of sitting here in Washington, D.C., you were in New Delhi, and we're doing it for the Indian Tax Administration, you'd identify the various components of source, and you'd say, we want all of them. We're going to tax it on one of 5 different bases.
Well, that's the destination.
And that's probably the way we should at least start out thinking.
But that's where the product is sold or consumed.
Well, not necessarily. You think that to the extent Indian software is developed in India and exported, they're not taxing it on a source basis? They're finding a way to tax it, trust me. And we ought to be thinking it. I'm not saying how I would conclude on any one of these things, and I certainly agree with your proposition that destination is part of the source inquiry. I'm not saying this is easy either, but I am saying that conversation is a conversation we haven't had in this country in 50 years.
Yeah, and I'm being pragmatic. What we have left in this country is a huge market.
Yes,
so let's use it.
I agree.
China's what China's throwing its weight around, and India. Why don't we use our huge market?
Any more questions? Yes.
The OECD has brought about, thank you. The OECD as the main topic that everyone's heard about is country-by-country reporting and disclosure. And David, you talked about enforcement being lacking in the U.S. Do you think increasing disclosure like the OECD has announced and that all G20 countries like China, India have adopted or are going to adopt, will that enhance enforcement and allow countries to better deploy their resources, and will it maybe negate importance of other rules like thin cap rules or CFC rules by increasing disclosure?
Well, I think it's going to lead to a pretty chaotic situation myself. I think for a while, maybe even for a long while, the greater amount of information available is going to lead countries to what someone called earlier as revenue grabs. I think that's pretty much inevitable. That there are going to be countries doing some strange things, and our companies, because they're present around the world, are going to suffer from that. I'm more concerned. I'm not so much concerned about the enforcement abroad. I'm concerned about the hollowing out of the revenue service in the United States. I think, you know, just to put, this isn't what you asked, but let me just make this one point, that, you know, we have, in the revenue service, there's now 85,000 employees. That's 15,000 less than we had 6 years ago. Of those 85,000 employees in the Internal Revenue Service, there are 250 of them that are under the age of 25. They're not getting new people. They're not hiring. It's not the most attractive place to work. People don't want to work in a place where you got a bunch of bozos yelling at you all the time about what a terrible job you're doing. So it's not the most attractive career path for a young person. And in addition, they don't have the money to hire people. This is not good. This is not good.
So I would agree with David, but I would say the tax system not only is really enforced by the accounting firms and the law firms and our withholding system, but I think we really need more and better resources, the IRS, but
You will need resources to help navigate all those disputes that will arise in competent, just to defend competent authority
there's that
cases and
too.
so forth, and that's,
There's that too.
Mike, did you have a question?
Mike for Mike.
Mike for Mike.
Yeah, it's Mike Schler. I mean, of all the people that need tax cuts in the U.S. these days, I'm not sure multinationals should be first on the list, that sort of at the cost of...
you're falling into the trap that they pay tax. It's born,
They do pay
think about
tax.
what the consequence of them paying it is.
But
Don't anthropomorphize them. Don't make them people. They're not.
That's fine. And the other thing is that, you know, we live in a world today where you set up shop somewhere in a tax haven or a low tax jurisdiction, you pretend that's where your residence is, and then you enter into you do sales around the world, and you enter into cost-plus arrangements everywhere. So all the places you're selling stuff and doing everything else make a tiny sliver of profit, and all the real profit is going to the tax haven where you set up shop with a few people.
Right.
I mean, it's not surprising under that system that every country wants more than their little sliver.
Right.
I mean, unless we do something, and you say, well, the source is where the research takes place, and maybe that's right, but ultimately, I think you got to go to where the sales are, whether it's formulary apportionment based solely on sales or something like that, or else it's not surprising all these countries around the world are saying they're being cheated out of tax because they're not getting any tax.
So that's what formulary apportionment based only on sales sounds to me a lot like a destination-based income tax. And sure, that's and you can think of the DPT as sort of that. The answer is yes, I agree with that.
Yeah, but we shouldn't be complaining about that.
I'm not complaining. I'm thinking it's maybe the only solution. David, I'm following David's lead.
Well, I would not limit it to that, though. I'm not, if, for example, if research is done in the United States, but sales are made around the world, I'm not saying necessarily I would give up on the U.S. claim to some of that revenue on a source basis. In other words, I'd be prepared to have a multi-layered interpretation of
that's
source.
not source, right? So that's a different definition of source.
Look, I mean, you can call it what you want. It's not residence, for sure. It's basically a source country, in my experience, typically looks to whether it has to bear a deduction. If it bears a deduction, its instinctive reaction is, if we bear the deduction for something, we're going to tax the income. I don't think that's a crazy way of looking at it.
We're wrestling with the problem of an income tax in a world of mobile capital. If you had a value-added tax and you had R&D here and the product was sold outside the U.S., we wouldn't collect a nickel of money on that. The export would be exempt. When we sold it into the U.S., we'd collect the tax. We're trying to do something that's really impossible, which is catch a light beam with that's moving around the room much faster than any of us can see it. Income taxes don't work in worlds of mobile capital. We need some kind of destination based. Alan Auerbach did a great piece. His modern corporate income tax is not an income tax at all. It's a consumption tax, but he calls it an income tax, and we're in the death throes of the income tax, I think.
Well, I'd say since we have all these smart people together, the reason we're having this conference is to figure out how we can do a corporate income tax, which is still taxing investment income at some level. So
At
whether
the
you think we
individual
should have
at the
a
individual
VAT,
level.
at least whether we should have a VAT more of our revenue is another issue. But even if you believe that, we still are probably going to want to retain an income tax. So.
Well, then if you want to tax income from capital, you have to tax it at where it's not mobile by the owners. Right. Well.
I'm not taking a position on the matter. Any other questions? Yes, Jody.
In his line,
More than one.
where you said, well, I'm not in favor of a VAT, like many of you people are, but then it seemed to me you came around.
No, I'm saying administrative. I was suggesting that every economist will tell you, oh, that's because it doesn't tax savings, is going to create a lot more economic growth, and that it's much better than an income tax for growth. I'm just saying, I'm not sure I fully agree with that.
Look what it did for Italy.
Right, that it's, the economic, I understand that when you can tax something twice, like the accreted wealth, that there's already income tax has been paid on, there's a nice bang for the buck, but over time, I don't know why, if a government takes money out of the economy in one form, either as a VAT or as an income tax, it makes a lot of difference to me. I don't have it in my genes to spend. So so that's my only point.
Okay, I have one more question. Time for one more question? No. Going once, going twice? Yes, Emma.
We have a lot of high-powered former international tax counsels or deputy assistant secretaries for international tax in the room. And I often look at these double taxation treaties, not from the developed countries' perspective, but from developing countries. Come to the conclusion that most of these double taxation treaties should be terminated, as Mongolia did with the Dutch treaty. And maybe where a country should start is a simple rule: if you deduct it, it has to be someone's income and domestic income. Any reaction?
I think it would be really unfortunate if all the network of world's tax treaties were terminated. They serve really important purposes. One of them is to allocate taxing jurisdiction, but they also serve significant administrative purposes and provide certainty. And I think that certainty is to the benefit of developing countries and developed countries alike. So it might be that you'd like to see different provisions in some treaties, but I think a world without treaties would be a much more complicated place.
Well, I sort of half agree with that. I think treaties with developing countries are a bit of a con, but I do think that avoiding double taxation, exchanging information, maybe a couple of the other provisions of the typical treaty are useful, useful in appearance and maybe even useful in practice. I do think that that I can see why developing country treaties, I sat through a bunch of lectures from the likes of Argentina on this subject, that why developing country treaties are, from their standpoint, are really a revenue loss, a net revenue loss, as we tend to go and tell them you've got to sign it in a particular way. I sort of see that point of view. On the other hand, I think Barbara is right. I think going in a world without treaties, you're just adding to what is inevitably going to be a pretty chaotic situation in the post-BEPS world.
I think that's a pretty chaotic situation is a good last word. So let's end it here, and I want to thank the panel for a very stimulating discussion.